Welcome to our strategic plan for Starbucks Corporation. This PowerPoint was created by Nazrin Kanlar, Annette Tennell, Ree Wonek, and myself, Diana Patterson. We chose to do our strategic plan on Starbucks because they are an American company that is widely known. Even if you don't drink coffee, you probably heard of them. Starbucks was founded in 1971 in Seattle, Washington by three friends, Jerry Baldwin, Zeb Siegel, and Gordon Balker. They all had a passion for fresh coffee. They started out selling fresh roasted gourmet coffee beans and brewing and roasting accessories. They were basically a wholesale company. In the beginning, they didn't sell espresso, but they did give out free samples of their brewed coffee beans so that people knew what they tasted like. The name Starbucks was chosen in honor of the coffee-loving first mate in Herman Melville's Moby Dick, and because they thought the name evoked the romance of the high seas and the seafaring tradition of the early coffee traders. In 1982, Howard Schultz joined as Director of Retail Operations and Marketing, and 2 years later, he convinced the founders of Starbucks to test the coffee house concepts in their downtown Seattle store. This was where the first Starbucks coffee latte was served. Though Starbucks strives to be an inviting neighborhood space, its global brand has over 29,000 stores in over 75 countries. They're an industry leader in coffee and coffee houses. They are not only an innovator in coffee, but take tremendous pride in their employees. They were first to offer full benefits to both full and part-time employees, as well as benefits to those in non-traditional relationships. They employ over 250,000 people worldwide. They try to have something on their menu for everyone, from kids to older adults. Their stores carry over 30 blends and single origin premium coffees. The blends are served in their espresso and frappuccinos, and they also offer non-coffee beverages, including teas, smoothies, refreshers. Among some of the food products they sell are baked items, sandwiches, yogurt, oatmeal, salads, and fresh fruit. And if you aren't interested in food or beverages, they also sell the brewing equipment, mugs, books, and other gift items. Starbucks' vision statement is to establish Starbucks as a premier purveyor of the finest coffee in the world while maintaining our uncompromising principles while we grow. They aim to be a premier purveyor, which means that Starbucks Coffee wants to achieve leadership in providing its products, especially coffee of the best quality. The company achieves components of its visionary statement by continuing its multinational expansion as one of the largest coffee houses and coffee companies in the world. It is not yet clear if Starbucks effectively addresses the finest coffee in the world, but its critics and analysts point out that coffee from McDonald's or Dunkin' Donuts may be better in Starbucks in some aspects. Their mission statement is to inspire and nurture the human spirit, one person, one cup, and one neighborhood at a time. This mission statement reflects what the company does to keep its business running. It is clear that the target consumers are given emphasis in the corporate mission. The following components of Starbucks' corporate mission statement include strategic management and growing the business. They inspire and nurture the human spirit, and one person, one cup, and one neighborhood at a time. Touching base a little bit on the organization, the ABLE analysis covers the customer groups, the customer needs, and their distinctive competencies. Starbucks' primary customer target market includes adults aged 22 to 60 years old, and the teenage audience is growing steadily. The most common trait of the Starbucks customer is that they're busy people and they spend a lot of time in their cars going from place to place. They spend a lot of time sitting in traffic, which makes their coffee splurge even more welcome. While Starbucks does have regular customers who drink just black coffee, they prefer a customer who will spend money on a blended drink and a snack without even thinking about the cost. Their customer needs are fairly simple. They want a good cup of coffee at a good price. They would like a nice place to meet with friends or just to catch up on work while they enjoy their coffee. They would also like good, reliable Wi-Fi. Their distinctive competencies, they have several. What separate them from the competitors. The most important one, especially to a coffee drinker, is that they are well known for their expertise in roasting and hand-built beverages. The company picks high-quality coffee beans which are ethically sourced, then verified and certified by a third party so that they meet customer expectations. They also offer their customers the ability to customize and create their own beverage that is unique to them. Another competency of the Starbucks customer is they emphasize their diversity. The company builds a diverse workforce to increase cultural competencies as well as to demonstrate inclusion within the company. The diversification of the workforce helps Starbucks utilize different opinions, talents, and capabilities. In addition, Starbucks develops a diverse network of suppliers which provide the company with valuable insight on product innovation and business solutions.
So the external forces that we had talked about before are the economic, social, political, technological competition, EFEM, and CPM. The economic force that we are talking about would be that the fleet of trucks are very mobile. We can take them, as I said before, to festivals, concerts, large events, which would have a very positive economic impact. We are not creating more storefronts, purchasing more real estate, which financially can be a large burden on a company and really not allow them to grow and be as diverse as perhaps a company like Starbucks would like to be. Now, social and cultural, this is a really important positive impact that Starbucks can do utilizing these fleets of trucks because they can go to cultural events and social events and get more visibility and therefore pretty much sell themselves by offering the products that they have because let's face it, everybody loves the Starbucks coffee and hot chocolate and teas. And they do already have a very good brand recognition. And this could really help drive the product even further with these fleets of trucks being able to go to various different social and cultural events. The political impact would be a low impact because Starbucks themselves right now, they're dealing with more of the corporate side of things. But in regards to the fleet of trucks, I don't foresee a large political impact. Technological, the fleet of trucks can be very, set up with technology or Wi-Fi, which would allow customers, once the truck is in their location, to place orders online, and then once they get to the food truck or the Starbucks drink truck, they would be able to pick up their orders. So technology will play a major part in these fleets of trucks where customers can still utilize the technology that they so enjoy to still pick up their orders very rapidly. The competition is much lower in regards to drink trucks because a lot of the trucks that you see are pretty much only food trucks and they serve Coke or soda-like beverages or water. They don't offer large types of coffees and tea selections. So in this case, us stepping into this competitive environment, the competition would be low initially, and I think that would bode well for Starbucks. For the EFM and the CPM, I'm going to have both Nazrin and Rianne make their comments in regards to those two external forces. The external forces are comprised of 7 different components or forces. One is the economic force, one is the social and cultural force, the political force, the technological force, the competition, the external factor evaluation matrix, and the competitive profile matrix. Now, when we look at the economic aspect of the external forces, we can see that there are various different factors that will have an economic impact on Starbucks. And those would be the people that are actually purchasing the Starbucks coffee, and those are the people or the middle class people that live in a house and have 2 incomes coming in. They have disposable income. Also, people that are around the world. The economic factor also would be the dollar value in the world markets. How much is the dollar worth in various different countries of the world, and the rise and fall of the various different global exchange markets could economically impact Starbucks. And the higher cost of the suppliers, in regards to sending coffee supplies, perhaps the coffee beans from South America to America is not as expensive as it would be to export them out to Europe. So those are all economic things that Starbucks does have to take into consideration. And of course, interest rates or other type of diseases perhaps that could impact the plants themselves, the coffee bean plants, those would all have a financial economic impact on Starbucks themselves. Now, in regards to the social and cultural and demographic aspect, there's been a shift towards healthier eating and diets, and people are just more conscientious. And they've actually placed a lot more value on leisure time, and more people are just spending time relaxing in restaurants and coffee shops like they do in Europe. And that has been a huge positive social and cultural impact on Starbucks. I think that's why Starbucks has become so popular, is that it's a place for people to go and hang out and use the Wi-Fi and either be by themselves or socialize. And the other thing is culturally, the demographics of the people that like to go to Starbucks, those are people that really love to be involved with the environmental footprint, and they're more on water conservation and energy conservation and recycling. And those are all the things that Starbucks does really well. They initiate many programs that reduce the environmental footprint through energy and water conservation. They recycle, and they have green construction. They actually created the greener cup to reduce the carbon footprint. So these new trends and needs for different products and services, those demands that the culture is making on Starbucks is meeting, which is really great. Now, for the political aspect of the external forces, it's important to pay attention to the importing and exporting of business licensing agreement, the local laws, what could make your product or your selling in a specific location more expensive, more complex, perhaps more difficult to negotiate, or it's perhaps even hiring and firing employees might be more complicated depending on where you are, especially in a foreign country. So these are all political things that Starbucks does have to take into consideration. Local laws are really important. The disruption of the supply chain, that could be really, really impactful in regards to an external force. This could be due to a natural disaster or political unrest or other type of calamity. And if they are not able to meet the demand of the coffee, then that's going to make Starbucks look bad. Now, the technological forces that we need to discuss are, well, technology is getting better and it's getting bigger and more widespread. And Starbucks relies heavily on this information of technology systems across the operations. They use their mobile apps to have people come and order their coffees early, so when they show up at the store, the coffee's all ready for them and paid for. And with the mobile trucks that we are recommending, this the technology factor would be also part of the fleet of trucks, which would be really beneficial. So in regards to the technology forces, there really would not be any negative impact for Starbucks. Starbucks has mobile payments. Their ordering app is about 11% of their sales, and people like to pay in advance. The other thing that technologically Starbucks offers to their customers, which is really nice, is they have free Wi-Fi, internet, wireless internet, and a lot of electrical outlets for their customers to use. And that is one of the reasons why that accessibility to customers is making them more of a lucrative place to come and just hang out and purchase their coffee. Now, the next piece is the competition. Now, the largest competitor of Starbucks is McDonald's. And so what they do is, well, I guess I would say it would be McDonald's and Dunkin' Donuts. So what they have to do is we have to look at some of the competitive factors, where people like to go and why are they a competitive factor. So it's very simply stated, competitors couldn't match with Starbucks business model. This is a modern coffee shop and it's serving as really a third place of an affordable luxury that people really like to enjoy. And they like to go there with their friends and colleagues, and it's away from work and home. Starbucks their primary competitors for coffee beverages are pretty much Dunkin' Donuts and McDonald's. Now, Dunkin' Donut brands, they've updated and they tried to declare war against Starbucks when it launched its American Runs on Dunkin' campaign, while Starbucks has created an internationally ethic and upscale environment where Dunkin' Donuts is still really presented as an all-American brand. Now, if we look at the EFEM, the external force evaluation matrix. Overall, the external factors evaluation matrix show that there are some opportunities for Starbucks to take advantage of and reduce the threats of competitors and the suppliers. And we can do that by making the following adjustments. Starbucks has the opportunity to add more items to its to its lunch and dinner menus, and even add coffee for their kids. But what they don't have yet, which is one of the really important strategic aspects that we are trying to drive forward, is they don't have a fleet of trucks, and this could increase their availability and let them connect with more customers instead of the customers coming to the coffee shops. Starbucks can expand its delivery service and offer a lot more out of a truck mobile coffee fleet to various different areas in addition to the stores that they currently have. So that is something that we really feel that we can have a positive impact on that external factor evaluation. Now, the competitive profile matrix, this is also where our strategic plan of adding the fleet looks really good. So if we take a look at it, it's hard to compete with McDonald's, but Starbucks needs to have a good strategy plan. So Starbucks could add more food, but McDonald's doesn't have a fleet of trucks that they could go out, these mobile units that could provide customers with the food that they're that the customers might need in various different locations. So Starbucks can find a way to reach the customers and expand their delivery service. And it can even offer more promotions to customers by having them come and visit Starbucks more often. All of the Starbucks competitors cannot offer the high quality of coffee that Starbucks is offering at this time. Even their generic coffee is using the highest quality of beans. Overall, McDonald's receives the highest CPN weighted score of 3.3, but Starbucks is right behind them at a 3.05 rating, where Dunkin' Donuts is much further on down the rating line at a 2.6. So it shows that McDonald's is currently the strongest competitor of Starbucks, but Starbucks is not that far behind them. And we strongly feel that with us offering this mobile unit that could go out into various different locations and reach more customers, that would make our CPM extremely high, and that would put us over what the McDonald's CPM currently is.
This is SWOT analysis for Starbucks. This covers their strengths, their opportunities, their weakness, and their threats. Starbucks is a very strong brand name. This comes from the fact that they operate over 29,000 stores in over 75 countries. When you hear the name Starbucks, most people automatically associate it with coffee. While I realize not everybody drinks coffee, they do offer other beverages and food items, and for this reason, they continually add to their menu. They also pride themselves in the benefits they offer to their partners. Partners is what they call their employees. They do this to try and retain quality help. They give their partners Spotify premium memberships for free, a free pound of coffee, a K-Cup box, or tea every week. They offer a 401k plan with a 5% match and 10% education reimbursement, and you only have to be a part-time partner. They were also listed on the 2018 Forbes Best Places to Work report. Opportunities for Starbucks out there. They're on track to open 12,000 new stores globally. Of these 12,000 stores, they plan to open 5,000 in China and 3,400 in the US. The expected time frame for these openings is 2021. Creating coffee trucks would also be another opportunity for Starbucks. They could go directly to the customer instead of the customer coming to them. If they were to provide coffee trucks in more populated cities like Chicago and New York, or even Milwaukee, people would definitely frequent their business. They're also on course to offer greener and more environmentally friendly products. They encourage customers to reuse cups, and they are choosing greener energy options and working to make all their stores LEED stores. While Starbucks may be a very strong and well-known company, they also have their weaknesses, and some come directly from the partners they employ. This was the case when store employees called the police and had two black men arrested for sitting in their store. The employees misread the situation and overreacted, causing a huge black mark on the Starbucks name, and people protested the company. Starbucks responded in a very professional and productive way by closing all of the U.S. stores to teach their employees about racial bias. Another weakness that hasn't really affected their bottom line is the pricing for their products. They are on the higher side compared to their competitors, but many customers don't seem to mind and continue to purchase their coffee. While Starbucks is on track to open over 12,000 stores, they're also set to close 150 stores in 2019. These stores are located in the most densely penetrated markets. The threats that come to Starbucks are the natural disasters that they have to worry about. They can't protect against them and they can't prevent them. They also have increased competition from all the local cafes that continue to open. Customers like to try new things and to support their local businesses. The last major threat Starbucks is facing is Coca-Cola buying the British coffee chain Costa Coffee. They're already a strong competitor in the coffee business for Starbucks, and with Coca-Cola owning them, their presence is going to be much stronger. Here we're taking a look at a perceptual map for Starbucks. This map is showing us the competitors of Starbucks at a low cost, high cost price point and a low quality, high quality product. While Starbucks is the largest coffee chain in the world, it doesn't come without competition. Costa Coffee is currently their top competitor, but they're located in the UK. We did touch base on the fact that Coca-Cola has purchased this company and will be bringing a strong competitive factor to the coffee business. They also have another competitor, which is Cafe Coffee Day. They started out in Asia but have expanded to some countries in Africa, the Czech Republic, and Nepal. When you think of Starbucks, you don't think that their competitor would be the local independent cafes, but they continue to offer exceptional service but aren't as easily accessible as Starbucks. And then the two last that will continue to give Starbucks a great deal of competition but don't have the same quality are Dunkin' Donuts and McDonald's. While they serve a mediocre cup of coffee, they do charge a reasonable price. This chart is showing the grand strategy matrix for Starbucks. I feel Starbucks falls into quadrant one. They're a very strong company with an excellent strategic position. They're very competitive in the coffee market and have managed to expand their brand over 75 countries, and they still continue to grow. They are heavily committed to the coffee market. They continue to look for new ways to add additional items to their menu or just selling their products in the grocery stores. They have the funding available to take risks when needed, but they're also smart enough to know when to close a store that isn't generating income. Let's explore Starbucks' internal strengths and weaknesses in the following slides. Starbucks takes its organization seriously. To ensure the company is running effectively, efficiently, and consistently, according to Lawrence Gregory, the 10 topics displayed on this slide ensure that its goods and services reflect the firm's high-end brand image. Premium quality service is ensured through servant leadership and a warm, friendly culture. Starbucks aims to maximize cost effectiveness through efficiency of workflows and processes. Garners market share by strategically and densely placing retail locations and in-store operations. The layout design of Starbucks cafes maximizes workflow efficiency. Starbucks Human Resource Management integrates organizational culture in all areas of the business. The organizational culture involves the employee's first attitude that cares for Starbucks workers. The company's strategy for its supply chain involves diversification of suppliers to ensure stability of supply. At the cafe's inventory management involves office automation and manual monitoring. Starbucks uses a combination of automated and manual scheduling tools, but strives to provide a flexible work environment for all employees. And Starbucks maintains its physical assets through dedicated teams of employees trained for maintaining facilities and equipment, as well as third parties that offer. Starbucks is a customer-oriented approach company, which means that a company operates under a set of beliefs that say that the priorities of an organization are customers' needs and satisfaction. To quote, customer-oriented marketing, a strategy that guarantees success. Starbucks and McDonald's, when it comes to its success, it is very important to mention the strategy the company applies, which is to blanket an area completely. This approach is to cut down on delivery and management costs, shorten customers' lines in individual stores, and increase foot traffic for all stores in the area. These approaches all contribute to Starbucks' competitive advantage. The production and development of Starbucks is to fully serve customers. Starbucks offers a wide range of beverages crafted and packaged, along with food, bakery, and meal options. Starbucks also markets its brand by selling serverware, coffee mugs, tumblers, and water bottles, and accessories, tote bags, keychains, etc. Products isn't the only thing Starbucks is selling. Starbucks' goal is to offer a complete experience. Operations focuses on the customer experience that ensuring that every customer is treated like the only customer. Staff is extensively trained prior to joining the team to ensure the Starbucks experience is consistent throughout the footprint. To quote Young May Moon and John Quelch in Starbucks, delivering customer service, channels of distribution. Almost all of Starbucks locations in North America were company-operated stores located in high-traffic, high-visibility settings, such as retail centers, office buildings, and universities' campuses. Product mixes tended to vary depending on a store's size and location. Starbucks research and development strives to remain relevant when it comes to beverage crafting, to keep innovation in motion. Starbucks offers seasonal menus, introduces new flavors, new blends, and even encourages customers and staffs to get creative with the Starbucks off menu. Items like the chocolate macchiato and the iced raspberry latte. Starbucks is an industry leader with a brand that is recognizable across the globe. Starbucks excels at bringing innovation to the masses by making luxury accessible to the masses. Innovation drives Starbucks' competitive edge. Through the mobile app, drink crafting, and the introduction of Starbucks credit card, with an IFE weighted score of 3.2, Starbucks has a strong internal position. Starbucks has few weaknesses despite bringing decadence into neighborhoods across the world. The Starbucks experience is expensive with specialty drinks averaging $7. Drinks offer little to no nutritional value for the health-conscious consumer, and many markets have actual Starbucks stores so close to one another that it makes operations costly. Starbucks has also relied upon non-traditional advertising, which includes social media presence and word of mouth. Starbucks uses four primary information systems: transaction processing system, supply chain management system, decision support system, and customer relationship management system. Transaction processing is done through point-of-sale software as well as through the mobile app. Data is stored for analytics related to sales, inventory, and it can assist with supply chain management. Decision support systems are manual, automated, and/or a combination of both, and help people make decisions about problems they met rapidly changing and not easily specified in advance. Customer relationship management is done in various ways, while primary interaction being through the mobile app. Customers can provide feedback, receive offers, as well as order, shop on their handheld device. To maintain a competitive advantage, we think that Starbucks needs to expand. Expansion would be a mobile fleet Star Truck, which operates as a food truck. Star Truck would bring crafted beverages to where the people are: beaches, parties, corporate events, etc. Mobile fleets would be able to advertise the brand as well as create opportunity for increased sales revenue.
Hi, this is Annette Tennell, and I'm going to be covering the financial aspect of Starbucks. We're going to go over some balance sheet information, the income statements, cash flow history, EBIT, EPS, financial ratios and analysis, a very interesting graph that we found, and some projected financial data. On this first balance sheet history that we are looking at, you can see that we have data from 2015 all the way up to 2018. Starbucks uses a third quarter as a year end, so you won't see December to December. It'll be like September to October, things like that. What's really interesting about this information on their current assets, you can see that there's a significant difference in 2018 versus the past few years. The past few years have had an upward trend with their cash equivalents, and other current assets, but there was a significant jump in 2018 in regards to what their holdings were, what their statement information was, to what we currently show in 2018. Some of those variables we'll be able to see as we're stepping through some of the data. I just wanted to point that information out to you because September looks very different than it has in previous years. So in this part of the balance sheet, we are going to be looking at the liability side. You can see there are some significant changes that are showing up between 2017 and 2018. And those are associated with the long-term debt, deferred liabilities, and of course, finally impacting the total liabilities. So in doing some research with the company, what I have found out is that they have decided to shift how they're actually getting money in to fund what they would like to do for the future. So at first they initially offered shares or sold stock, which means as the stock value increases, that liability the company has to pay back to the shareholder, including dividends, because they had agreed to pay dividends, which kept increasing. Well, now what they have decided to do is change, and they are purchasing back the shares that they have sold to customers, and between 2017 and 2018 they purchased back over 75% of the shares that they had originally sold. And in turn, to raise the money for those shares, they are selling bonds. They're selling bonds with different maturity dates and different percent rates. And what that does is that locks in the interest rate that they are going to have to pay in the future when those bonds come to maturity. So as you know, the interest rates are starting to increase slowly. So what they've done is they sold billions of dollars worth of bonds. And what they're doing with that money is they're purchasing back the stocks, but what they have to pay back in the future, the interest rate on those bonds for them borrowing that money is actually pretty small. It's like 3.25%. And when you think how the market shifts, stock market and bond market, how it moves, at some point in the future, we might be considerably paying or receiving more interest for our deposits at the bank, but then because they've locked in on these bonds at a much lower rate when they sold them, they don't have to pay a higher rate in the future. Whereas the stockholders, as the stock goes up, they would have to pay back the stockholders. When the stockholders sell their shares, they would have to pay back those shares at a higher price. So what they're doing now is they are basically selling bonds to pay off the stocks so that they can have a cap in the future of the amount of debt that they have to pay, knowing that they've locked their debtors in a way with a small interest rate. I hope that makes sense. If not, you can talk to me and I'll be able to discuss it further with you. But in doing so, the company has, in a sneaky way, actually acquired a lot more cash that they can use for funding strategic projects and plans. And this is where our project can come into play, because they have decided to raise so much money via the bonds that they right now are trying to look for ways to strategically move the company forward. And that's where our idea of coming up with these mobile units, Starbucks mobile units, is actually perfect timing at this point. And so we need to discuss further how much money we would like Starbucks to invest in for these fleets of trucks. And our initial estimate in regards to starting several fleets of trucks in larger cities was approximately $100 million. And that would purchase the trucks, get them set up, purchase the insurance, and place those trucks throughout the country in the larger cities. And that would be an initial investment. But of course, with depreciation and stuff, it will be actually a really smart investment. So I'm going to leave it at that. We can discuss more of this in the future. On the stockholders' equity side of the balance sheet, you can see that there is a decrease now in stocks that are out in distribution because the company is right now in the process of purchasing these guys back, and they've been doing so very rapidly. Now, if we look at the retained earnings, you can see that has decreased. The reason that has decreased is because they are in the process of taking some of the earnings and some of the money that they have and purchasing back those stocks. And this all has to do with their great plan of shifting their the money that they have, which initially was through stock sales that would help them raise capital for their business, to now selling bonds instead of stocks, because bonds, they can cap what the amount of interest is and what the maturity date is, so that they can control what their future debt is. Whereas stocks, you never know how they move, and if they continuously go up, that means at some point the company is going to have to pay more and more out for shares. And that's something the company decided not to do anymore, which means they are positioning themselves very strongly for a long-term organization that looks not to have debt probably within 10 years down the road, and strictly having no shareholders, which is quite interesting. So, but that's what they're doing. So they're decreasing the amount of shares that are out there, and they're purchasing back their stock, and they are selling bonds. So the bonds is affecting their liability, but the equity is decreasing significantly because that's related to the stocks. Here also, the annual income statement shows that these are actually in billions. The revenue here is continuously increasing, and we can see that by the bar, the trends that you can see on the side, the cost of revenue, or the cost that it costs for them to generate revenue, is increasing, but the revenue that they're generating, or the net income, is also increasing, but at a higher rate. So overall, the company is continually growing, making a great profit, being extremely strong on an annual basis. And within a 4-year period, they went from almost $3 billion to $4.5 billion in revenue, and that's, or in income. So that is really, really, really good. So it is strategically placed, financially placed, for them to step out and do some other interesting strategic plans, like the fleet of trucks that we are offering. On this income statement history, I wanted to depict the historical revenue that Starbucks has had. And what's really nice about this is it shows that the company is well positioned for some strategic plans like the one that we have. And they are doing really well. Their goal is, on an annual basis, to actually have a 10% increase of revenue annually. And so I did a quick 8-year average analysis, and I could see that on the average, they're actually at 11%. despite between 2016 and 2017 only having the increase of 5%. So they are doing what their goal is for the annual increase of revenue, which is by 11%. Now, based on how large this company is and what they would like to do, and that they are expanding globally, our strategic plan of adding these fleets would actually increase this revenue, because remember, our goal is to have these fleets of trucks out in locations, which would really be, even more helpful in the summer times or the summer months when the revenue is actually low for the company. So I strongly believe, I should say my team and I strongly believe that our strategic plan of adding these fleet trucks throughout their country in larger cities throughout the summer months and offering colder beverages, protein drinks, cold teas, and other options for our customers would significantly increase the revenue that the company is seeing at this point, because at this time, all of these percentages that you see are all based on June, July, August, and September being very low income revenue generating months for them. And that's where our strategic plan would really be beneficial for the company, which would help drive up this revenue. On the cash flow history, we can here see again the income statement piece that we've discussed before, and the income is continuously going up, which is great. The depreciation has also been going up. That's because they are expanding their stores, they have more equipment, so there's more depreciation that they're taking into account. When we talk about their accounts receivables, you can see that the accounts receivable, they were having a little bit of a hard time collecting some of their receivables, but now they've turned the corner. They have become more aggressive or better able to handle their accounts receivables. The other operating activities, you can see that amount increased, and that's because they're having to spend more money in regards to updating some of their equipment, and that's to be understood. I mean, that can fluctuate from year to year depending on how many stores they opened and how many pieces of equipment that they had purchased at the time, and if they're all having to be changed out at a specific time, then we can see that that is going to be impacted. The liabilities component, we've discussed before that they have increased their liabilities significantly, but that is because they have decided to purchase back their stocks, and they are selling bonds to raise money to do a lot of their strategic investments, both globally and in the United States. And now they have all of this money that they're raising. This liability is a long-term liability. It's a long-term debt, and these bonds will not be due probably for anywhere from 5 to 15, 20 years. And they're locked in at a rate. So this was actually a very smart strategic plan that the company had to raise capital by selling bonds, because they know what the ceiling is or what the cap is of their debt. Whereas stocks, again, they would have to continuously pay dividends, the stocks would go up, and then their liability towards the stockholders would increase. So they decided to shift their liability from their stockholders to selling bonds and having bondholders have a part of the company. On this last cash flow history piece, we can see that a lot of these numbers really don't show that significant of a shift, besides the other investing activities. And again, it's because the company's trying to do more investing and diversifying. But compared to some of the other information that we have seen, this piece of the cash flow investing activities does not look too much out of the norm. So we can just go on from this one. And here it continues with the cash flow history. We can see the sales and purchases of the stock. This is where you can really see that the stock has has declined, or that the company's actually purchased a significant amount of stock. And this right now, these are in billions. So we are looking at the company has purchased back almost 7 billion in stocks, and their goal at this point is to purchase at least 10 billion back, which would be close to 80% of the stock that they have. So they're looking to purchase back the stocks because the stocks continue to increase, like we had stated before, and they are incurring long-term debt with bonds to raise equity. And this, of course, will impact your cash flow. So you can see that the cash flow is significantly higher. That's because the cash flow was moving based on the purchase of the stocks. But that's okay because the company is a very large company. It has very deep pockets, and it is able to strategically place itself in the long term with this particular plan of purchasing back the stocks and actually selling bonds to raise capital. And that's, again, where our strategic plan is perfect timing for Starbucks at this time. Our EBIT, or earnings before interest and tax, you can see has been increasing on a regular basis. This has been really nice because historically you can see that the earnings has been growing, and it's been growing substantially, especially between 2017 and 2018. And based on some of the investment strategies and stuff that they are doing this year, I anticipate that we will see a continuous upgrowth or uptick on the earnings before interest and taxes for this company. The EPS, or earnings per share, is based on the revenue that Starbucks stockholders have. And here you can very easily see that between 2016 and 2018, there has been a third of an increase in regards to the earnings per share. And this is one of the reasons why Starbucks has decided to look in the long term. Within just 2 years having the stock's earnings per share go up that much, this is why they have decided that they are going to stop selling shares, purchase shares back, and sell bonds instead, where they can actually put a cap on what their liability is going to be in the future, which is extremely smart. They are at this point still having shares out in the market, and those shares are receiving dividends, which are increasing, but at some point they are looking to purchase all the shares, so there really won't be shareholders out in the stock market. So it's going to be interesting to see how they're strategically going to place themselves in the market itself. But that being said, again, because they have been selling bonds, they have money, plenty of funding right now to strategically place these fleets of trucks out there for us with our strategic plan, because they are in a position right now to strategically make some major shifts in the company, and they're looking to do so. On this financial ratio analysis spreadsheet, you can see that the ROE, or the return on equity, has significantly increased. And this is due to two different factors. Number one, between 2017 and September of 2018, Starbucks decided to close stores that were not turning a profit. So what they did is they went through all their stores, and this was globally. They closed 8,000 stores in March alone of last year. And that what they've done is in turn is they've cut out their debt and their liability obligation to those stores. So instead of them being a losing investment for them, they just decided to cut their losses and close those stores. 8,000 stores is a significant amount of stores, given that right now they have 23,571 stores globally. So that's basically a quarter of the stores that they decided to cut because they were not doing well or not turning a profit. But this in turn has increased their return on equity, which means their expenses for those stores that were not turning a profit has been pretty much cut out, which makes the company look significantly better. Again, because the number of stores they've cut. Now, what they've done also, which is nice, is they have the ability to give a certain amount of time for stores to become profitable, and if they don't, they have no problems shutting down the store or moving to a new location. With our strategic plan of investing in mobile units, the company doesn't have to invest in real estate. They can turn around and see if there is sales in a specific area based on the sales of the truck, and if there are enough sales to generate significant amount of revenue that would warrant them to actually make the investment of a store in that location. So it's not just a matter of having a portable unit that can go to various different venues, but it can also be used as a market testing point for various different regions to see if it is an area that Starbucks would like to invest into or purchase some storefronts and establish a business in that region. So having our strategic plan really is a multi-purpose plan that would really benefit Starbucks at this point. On this financial ratio analysis, we can see that the times interest earned has decreased, but the long-term debt to equity has increased. But that is because the company is right now going through a strategic readjustment or realignment to better position themselves for future strategic plans and what they want to do. This is the perfect time for us to step in and pitch for those fleets of trucks, because Starbucks would be able to place those trucks in various different locations where they're thinking that they might be able to open a storefront, and they can test the market utilizing these trucks. In addition, that they would be able to utilize these trucks during summer months or various different times or various different events in order to raise more revenue. So this would offer Starbucks a second option versus just having to purchase real estate, open the stores, and see how they do in a specific location, and avoid them having to, like they did last year, close 8,000 stores that were just not generating revenue or were causing losses for the company. So making the investment for a fleet of trucks makes perfect sense for Starbucks at this time. On this financial analysis or financial ratio analysis, you can see that the inventory turnover has been increasing, and the fixed asset turnover has been decreasing. The company is doing much better with their asset turnover. They are much leaner and becoming more efficient. Now, the return on total assets, the ROA, you can see went up significantly. So what they've done is they turned around and they had quite a few stores, actually 8,000 or a little over 8,000. It was 8,150 that they closed in between 2017 and 2018. And what they did is when they obviously purchased those storefronts or that real estate at the time, it was worth a specific dollar amount, and then those values, those real estate investments, they've increased. But what they were able to do is sell that real estate, make money off of it, and make a profit off of it. In addition to that, they were able to mitigate also losses on those properties because they didn't keep the stores open in order for them to keep losing money. So what they did then is when they sold all those properties, they had a return on their assets or their investments at the time. In addition to that, all of the other changing factors that the company has done this year has positively improved their net income. Again, closing many stores that were losing money, but yet going globally and investing in various different countries at this time, which has really benefit the bottom line of Starbucks, and strategically placed them in a position where they can make some strategic plans and initiatives and try to figure out what they want to do now with all of this newfound money that they have. So again, this is one of the reasons why we strongly feel that this is the time for us to make our pitch for the fleet of trucks, because their net income has increased significantly and they have decreased their real estate assets that they had by closing stores that were not generating a profit. So now they're trying to figure out how can they move forward and place themselves in locations without having to purchase the real estate. And this is where our strategic plan perfectly aligns with what they need. Looking at the balance sheet history, we pulled up just a one-year trend, but this seems to be an annual event for the company. And this is kind of significant for us to look at when we're looking at how can we strategically position this company to do something more. And during the months of June through October, that's when the company has a significant decline in sales and the stocks drop, and there's a large trend, and that trend happens to be during the warmer months. So that's also when people are not looking to purchase hot beverages. So for us to come up with a strategic plan for Starbucks that could help boost this sector of the company would be a significant positive impact for the company, and that's something that we look forward to doing. What's really interesting too is that they've set their financial statements to end the end of September or beginning of October, and that is probably because they just want to get that little niche in there. But when things start getting colder out, you can see that's when they start their financial year. Their fiscal year starts on October the 1st. So that's pretty interesting. Reuters is one of the financial locations that I like to gather my data from, because they have an amazing way to depict what's going on within a corporation's financial statement. And this is a really good example of that. So as I mentioned, in 2017 and 2018, between 2017 and 18, Starbucks decided to start selling off companies or branches that were not doing very well. So what they did is they pretty much cut out the companies that were causing a drag on their profit margin and on their net income and their operating margin. So what they did is they decided to get rid of some of the companies that or branches that were not doing very well, and then in turn just focus on the ones that were doing really well. So that shows up really nicely as a blip here on this graph, where you can see in 2018 their net margin actually went up because they had more margin or more money that they could actually use to invest in. But because of the buyback of the common stock and the sale of the bonds that they have, their projected debt is going to be going up. So, but at this point, it doesn't look like that part is really impacting this graph. The projected income statement here is really nice because it does show that there is a continued upward movement in regards to the sales that the company is going to have. So Starbucks will continue to do well into the future. People love their coffee, I guess. So their operating profits before the taxes, that is continuously increasing. The net income is going to continue to increase for 2018, but then it's going to drop off with again an increase going into 2021. So that's what I like about doing a more longer term projection, that a 1-year projection in this case specifically because of how unusual 2018 was for Starbucks. I felt that a longer projection was necessary, which Reuters is able to provide for us very nicely. The dividends per share will continue to go up, so if you haven't invested yet in your Starbucks shares, highly recommend you buy some. And the yield is increasing, which is great, and so is the price. So at this point, it looks like everything is upward mobility and everything is looking great for Starbucks for the future, with the exception of what they were doing strategically in 2018. Reuters is giving a really good depiction here of what's going on in regards to the financial projection for Starbucks within the next 3 years. And what we can see here is the distinct changeover that Starbucks has done when they decided to purchase back some shares and then start to get income through selling bonds. And selling the bonds, that means that this is debt that they're incurring that they have to turn around and pay at a later date. But what's nice about it is that they're able to cap that debt with the interest that's listed on the bond, where shares would continue to go up and the stock market would go up and the prices would go up as to what they would actually owe back to the shareholder. So the sales on this depiction you can see is continuously increasing, which is really great. The earnings before interest and other debt, taxes, and accruals is is also increasing, but at a very slow and acceptable rate. So overall, the company is strategically well placed, even with this graph, to step into the strategic changes and strategic planning implementations that we have for it at this time. On this projected balance sheet, this particular analysis is related to the book value per share and the cash flow per share. And remember, what they're doing is they're buying back the stock and decreasing the amount of stock that's actually going to be out there. So the book value per share is going to be decreasing, and so is the cash flow per share. So they are slowly purchasing this back, and they started in 2018 where they made a significant buyback of shares, and it was over $6 billion worth of shares that they purchased back. They are purchasing back at the market value, but here you can see how that buyback really impacted the next 3 years of forecasting. And this is because the company is shifting their strategic capital income that they're looking for from, instead of stock sales, to changing to bonds. The earnings per share projected for the next 3 years is continuously going up. Now, this was done just prior to the forecasting in regards to the changeover that Starbucks is doing for purchasing more shares back and in turn offering bonds to raise capital. So what Reuters is doing here is they're saying that over the next 3 years or 4 years, that the dividends were projected to go up significantly. They're going to continue to go up, and your earnings per share is going to go up. So the company is going to be paying more money to the shareholders, and this is what they decided they're going to try to mitigate with purchasing back some of those shares, because the more shares they have out there, the higher dividends they have to pay out. So they are looking to cut that part of the expense that the company is currently incurring. But again, this is their long-term strategic plan, which makes total sense because they decided to shift from stock-based capital to bond-based capital.